Hey, it's hard to believe we're in March already, and boy, do we have some very interesting things going on in the world. We wanted to come to you today to talk a little bit about what is going on with this attack in the Middle East and how that may be impacting your portfolios. Now, watching the news and reading the news, there's a lot of information out there. There's really been no great rationale for why we're doing this. And one of the latest polls I saw is that less than 1 in 5 Americans actually supports this. So that's the political side of things, where we've got an administration that seems to be thinking that it can do whatever it wants, whenever it wants, to affect whatever regime change that it thinks, even though, interestingly enough, this is one of the things that got them into power by saying that they were not going to mess with foreign countries and their leadership. So, how does this impact your portfolio? Well, right now we're seeing the market take a nosedive. Iran and the Middle East, whenever there is an issue in the Middle East, the first thing that takes a hit is energy. About a third to about two-thirds or so of oil comes from somewhere else, but about a third of the oil gets shipped through the Strait of Hormuz, right? That's the little strait there that goes between the peninsula where Saudi Arabia is and where Iran is. That's a lot of oil that comes through there. And if Iran really wanted to, it could probably shut down that entire strait, which is one of the reasons that we have to continue to attack and try to take out the ballistic missile capability, because you can imagine what would happen if one of those hit one or two oil tankers. It would be not only an environmental disaster, but it would be have a real impact on energy around the world. But that's what's going on, right? We're seeing the market go down because people are thinking, if this becomes protracted, and most conflicts where you remove a leader in a volatile region that creates a vacuum will create ongoing protracted turmoil. What that's going to do is increase the price of energy. Now, energy then will bleed through into other prices. We need energy to manufacture things, to heat our houses, to cool our houses as the warmer weather comes along. All of this then leads to inflation. One of the things that has not really been talked about a lot, but is still there. Inflation is still higher than the Fed wants. And last time we talked a little bit about the Fed and cutting rates. Well, the Fed is not going to be able to cut interest rates if prices accelerate and start going up. They're going to have to slow that down. And so the knock-on effect here is that this could create problems that bleed through into other sectors. Now, from a market perspective, immediately everything's going to take a nosedive, right? The stock market is a risk on, risk seeking place. And as soon as they see something that they don't like, investors, they're going to start selling. Prices are going down. However, what we've seen historically is that over 18 months following the beginning of a conflict, 18 months later, the stock market is up and about up where it has been historically. Anywhere from 6 to 8 to 10% is what we're seeing. So don't panic right now. Yes, the headlines are jarring. Yes, there's a lot of questions politically, constitutionally about what's going on. But from a market perspective, markets are forward looking. Right now, they're worried about the impact on energy and they're worried about potential inflation. When we get down the road, the markets are going to be looking at something else, right? Something else in the future. We're going to know a little bit in 6 months what happened to energy, what happened to inflation. At that point, what the markets are going to be looking for is, where do we go from here? Have we adjusted to the new normal? Are there other shocks that we need to be aware of? How is the market for goods and services adjusted? All of these things they'll be looking at that point, and that may bring a whole new set of risk factors in. But what you need to keep in mind is, whenever there is one of these shocks, the market will inevitably go down, followed by a spike up. Just think about COVID. March and April of 2020, the market was in a free fall. Well, 12 months later, it was way up. And that's just the way that the market goes. So we need to hang tight, and we're going to do what's called rebalancing. That means that as assets like stocks get beaten down in price, we may have a change in the overall allocation of your portfolio. Well, what are we going to do? Those safe assets that appreciated, we're going to sell, lock in some gains, take those gains, and we're going to invest them in the underperforming, the stock asset. So we're selling high and buying low. That does two things. Number one, it helps with our long-term return. Number two, it helps us manage volatility because we are moving back to your risk-based asset allocation. And number three, it allows us to be proactive during a stressful time as opposed to sitting here and hoping that by holding on to our seat, we're not going to go flying off the roller coaster. So, if there have been any material changes to your goals, give us a call. If you're worried about anything, give us a call. We'd be happy to talk through it and talk specifically how we are dealing with your portfolio to help you reach your goals. Have a great week. We'll be in touch soon.